Most people focus on how much money they make from investing, but smart investors focus on how much money they keep. Taxes quietly eat a huge portion of your returns, and if you don't structure your investments properly, you lose thousands every year without even realizing it. What separates average investors from wealthy ones isn't luck, it's tax efficiency. Wealthy investors strategically choose accounts, assets, and timelines that minimize taxes and maximize compounding. In this video, you'll learn the most powerful tax-efficient investing strategies used globally, and how you can apply them in Pakistan and worldwide to grow your wealth much faster. Once you understand these principles, you'll never look at investing the same way again. Smart investors know that tax planning is not optional. It's part of the investment process itself. When you optimize taxes, your portfolio grows faster without increasing your risk or workload. 1. Understand how taxes affect your investments. Before you optimize taxes, you must understand how they actually reduce your return. Capital gains, dividends, and interest income are all taxed differently depending on your country. In Pakistan, for example, capital gain tax, CGT, on stocks varies with holding period. Dividend income is taxed differently from capital gains. Real estate gains depend on filer status and holding time. Globally, similar rules apply. Short-term gains are usually taxed higher than long-term. Knowing these differences allows you to choose smarter strategies. When you understand how each investment is taxed, you can structure your portfolio to legally retain more profit. Most beginners ignore taxes until the end. Smart investors plan for taxes before they invest a single rupee or dollar. This mindset shift alone can increase your long-term returns by 10 to 30% without changing your risk level. Understanding taxes is like knowing the rules of the game. Once you master them, you stop losing money unnecessarily. 2. Prioritize long-term investing to reduce taxes. Holding assets longer almost always reduces taxes. In many countries, long-term capital gains are taxed at lower rates than short-term trading profits. Even in Pakistan, holding stocks for more than a year significantly reduces CGT, meaning you keep more profit. Long-term investing also protects you from unnecessary transaction costs and emotional decisions caused by market volatility. The longer you hold, the more compounding works in your favor while taxes shrink. Many investors trap themselves by trading too frequently, unknowingly increasing tax liability. Wealthy investors do the opposite. They buy quality assets and hold them long enough to benefit from both compounding and tax-efficient growth. Long-term patience becomes a hidden tax strategy that multiplies wealth quietly and consistently. If you want to reduce stress and maximize returns, long-term investing gives your portfolio time to grow without the drag of frequent taxation. 3. Use tax-advantaged accounts around the world. Governments offer tax-advantaged accounts to encourage investing. These accounts reduce or delay taxes on your profits. Examples include IRA, Roth IRA, US, TFSA, RRSP, Canada, ISA, UK, Superannuation, Australia. In Pakistan, investors can use voluntary pension schemes, VPS, tax credit up to 20% of taxable income mutual funds under Section 62, tax credit for investing in approved funds, employer pension contributions, tax-deferred growth. These accounts help you legally save taxes while your investments grow. Even small contributions today can snowball into massive long-term wealth, because taxes aren't eating into your compounding. The earlier you start using tax-advantaged accounts, the more powerful the benefit becomes. For global investors, combining multiple tax-beneficial accounts can create an optimized system where money grows tax-free, tax-deferred, or tax-reduced based on your strategy. Using these accounts separates disciplined investors from emotional savers. It's a long-term structure that builds wealth automatically. 4. Choose tax-efficient assets. Some assets naturally create lower tax burdens. Examples: index funds and ETFs, lower turnover, fewer taxable events, dividend stocks with low tax rates, hold-to-maturity bonds, real estate with long-term appreciation. In Pakistan, index funds and ETFs are growing slowly, but mutual funds with low turnover can still offer tax advantages. Real estate also has favorable tax treatment depending on holding period and filer status. High-frequency trading, forex, or short-term crypto trades usually lead to higher taxes. Smart investors pick assets that align with long-term growth instead of short-term excitement. By choosing tax-efficient instruments, wealthy investors quietly reduce annual tax drag, a silent killer of returns. Over 10 to 20 years, this difference becomes massive and can double your effective wealth. Your asset choice is not just about returns. It's about how much of those returns you actually get to keep. 5. Offset gains with losses. This is one of the most powerful tax strategies used globally. Tax loss harvesting means selling losing investments to offset the taxes on winning investments. For example, if you make a $1,000 profit but lose $1,000 on another asset, your taxable gain becomes zero. This reduces your tax bill today and sometimes even carries forward to future years. In Pakistan, CGT rules allow loss adjustment within the same year, which many investors ignore. Globally, tax loss harvesting is used by hedge funds, wealthy families, and automated financial platforms to keep taxable gains low. This strategy requires discipline, but it significantly increases long-term returns. Even small harvested losses add up over time, protecting your portfolio from unnecessary tax drag. It's not about losing money, it's about using losses strategically to protect your profits. Done correctly, it smooths your tax burden and boosts your net growth. 6. Use dividends. Wisely, dividend income is taxed differently than capital gains. In Pakistan, dividends often have a fixed withholding tax, which means you pay up front whether you're profitable or not. Globally, some countries offer reduced rates for qualified dividends. To maximize dividends tax efficiently, focus on companies with stable, moderate dividends. Use dividend reinvestment plans. DRIP. Hold dividends in tax-advantaged accounts. Reinvested dividends compound rapidly when taxes are minimized. Most beginners chase high-yield dividends without understanding that higher yields often mean higher tax drain. Smart investors choose stable dividend payers that generate long-term value instead of fast but heavily taxed income. A balanced dividend strategy keeps your cash flow strong while protecting your taxable income. Dividend efficiency can add thousands to your portfolio over time. 7. Use real estate tax advantages. Real estate is one of the most tax-advantaged investments worldwide. Benefits include depreciation deductions, lower tax on long-term appreciation, expense deductions on repairs and improvements, rental income taxed differently. In Pakistan, real estate taxes depend heavily on filer status, holding period, and property type. However, long-term appreciation remains powerful and incredibly tax-efficient. Globally, investors use real estate to shelter income through depreciation, reducing tax liability without reducing cash flow. Real estate also allows forced appreciation, meaning upgrades increase value without tax until you sell. Smart investors combine appreciation, rent, and tax savings to grow wealth from multiple angles. With the right strategy, real estate becomes both an income generator and a long-term tax shelter. 8. Avoid the biggest tax mistakes. Most investors lose wealth not because of markets, but because of tax mistakes. The biggest errors are trading too frequently, holding investments in the wrong account, ignoring tax loss harvesting, taking profits too early, forgetting filing rules, not planning tax strategy from day one. Tax mistakes compound negatively, just like investments compound positively. Avoiding these errors keeps more money in your portfolio, allowing compounding to work in your favor. Wealthy investors don't just pick good assets, they avoid bad tax decisions that can destroy returns. Being tax smart is one of the easiest ways to outperform other investors without taking more risk. If this video helped you understand how tax-efficient investing multiplies wealth, now is the time to act. Review your investments, analyze your tax exposure, and apply at least one strategy today. Whether it's using tax-advantaged accounts, optimizing long-term holdings, or harvesting losses wisely. Share this video with anyone who wants to grow wealth faster. Hit like and subscribe for more strategic investing content. Remember, you don't need to earn more to build wealth. You need to keep more of what you already earn. Start applying these tax-smart strategies now and let compounding work with you, not against you. Your future wealth depends not just on earning, but on protecting your returns from unnecessary taxes.